basis points over our last two meetings and by 100 basis points since the beginning of the year. And finally, the weakness we are seeing in the Canadian economy is more than a cyclical downturn. It is also a structural transition. The U.S. trade conflict has diminished Canada's economic prospects, and the structural damage caused by tariffs is reducing our productive capacity as well as adding costs. This limits the ability of monetary policy to boost demand while maintaining low inflation.
For the first time since January and the start of the trade conflict, the bank is publishing a baseline outlook for economic growth and inflation rather than alternative scenarios. It's now been more than 6 months since we've been living with U.S. tariffs. And while U.S. trade policy remains unpredictable, its impacts are becoming clearer. So let me expand on what we're seeing in the economy and how that played into our deliberations. While the global economy has been resilient to the rise in U.S. tariffs and increased uncertainty, the impacts are becoming more evident. Trade relationships are being reconfigured, and uncertainty is dampening investment in many countries. In Canada, the impacts of U.S. trade policy are already clearly evident. GDP contracted 1.6% in the second quarter as tariffs and uncertainty reduced exports and business investment. U.S. trade actions are having severe effects on targeted sectors, including autos, steel, aluminum, and lumber. At the same time, household spending was resilient in the second quarter, with strong consumer spending and a pickup in residential investment. The labor market is soft. Employment gains in September followed 2 months of sizable losses. Job losses have been concentrated in trade-sensitive sectors, and hiring has been weak across the economy. The unemployment rate remained at 7.1% in September, and wage growth has slowed. In the second half of this year, GDP growth is expected to resume, but remain weak, averaging only 0.75%. It should then pick up on a quarterly basis in 2026 as exports and investment recover to average about 1.5% in 2027. This implies excess supply is only taken up gradually. Even as growth recovers, the entire path for GDP growth is lower than before the shift in U.S. trade policy. By the end of 2026, the level of GDP is about 1.5% lower than forecast in January. About half this downward revision reflects lost capacity as a result of the trade disruption. The other half is due to weaker demand. CPI inflation was 2.4% in September, slightly higher than the bank had anticipated. The bank's preferred measures of core inflation have been sticky, around 3%, but upward momentum has dissipated. Looking at a broader range of indicators, underlying inflation looks to be around 2.5%. The bank expects inflationary pressures to ease in the months ahead and CPI to remain near 2% over the projection horizon. If the economy evolves roughly in line with the outlook in this monetary policy report, Governing Council sees the current policy rate at about the right level to keep inflation close to 2%, while helping the economy adjust through this period of structural change. We will be assessing incoming data carefully relative to the bank's outlook. U.S. trade policy remains unpredictable, as events over the weekend reminded us. There continues to be considerable uncertainty both about U.S. tariffs and their impacts. The range of possible outcomes is wider than usual. We need to be humble about our forecasts. If the outlook changes, we are prepared to respond. Les entreprises et les ménages canadiens ressentent les conséquences
Canadian businesses are feeling the effects of these increased protectionist measures. It is difficult, and ongoing uncertainty is compounding the difficulty. For many months, we have been stressing that monetary policy cannot undo the damage caused by tariffs. Increased trade friction with the United States means our economy will work less efficiently, with higher costs and less income. Monetary policy can help the economy adjust as long as inflation is well controlled, but it cannot restore the economy to its pre-tariff path. The Bank of Canada is focused on ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. Les entreprises canadiennes ressentent les conséquences de la montée du protectionnisme américain. C'est difficile et l'incertitude.
For many months, we've been stressing that monetary policy cannot undo the damage caused by tariffs. Increased trade friction with the United States means our economy will work less efficiently with higher costs and less income. Monetary policy can help the economy adjust as long as inflation is well controlled, but it cannot restore the economy to its pre-tariff path. Above all, the Bank of Canada is focused on ensuring Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I would be very pleased to take your questions. Thank you.
Thank you, Governor. Okay, we will go to questions now. We're starting with the reporters here in Ottawa at the bank, and then we'll go to those who have joined remotely. As usual, I'm going to ask you to please limit yourself to one question so that we can get around to every media outlet. And if I forget to do so, please state your name and affiliation. For those in the room, please press the button on the microphone in front of you to activate it. That way everyone can hear the question, and then press it again to turn it off once you're done. Avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait et comme habitué.
And of course, please feel free to ask your question in the official language of your choice.
I'm going to call first on Mark Rendell of the Globe and Mail.
Mark Rendell du Globe and Mail.
Thanks for taking the question.
Merci de répondre à nos questions.
We have the policy rate only at the lower end of kind of the neutral range. It's not in deeply stimulative territory, and yet your projection for the economic outlook is pretty bad. It's pretty weak. And you talk about the kind of constraints on monetary policy in stimulating the economy when we're going through this kind of structural shift. Can you unpack that a little bit? Why are we not talking about more stimulus from the Bank of Canada when we are talking about a very weak economic outlook and one that, you know, there's going to be permanent scarring from the U.S. trade policy?
Well, first point, Mark, is we're now at the lower end of our range of neutral. So monetary policy is providing some stimulus. But as I tried to outline in my opening remarks, the role of monetary policy in the current situation is somewhat limited. What we're going through is not just a cyclical downturn. And what do I mean by cyclical? Cyclical means, you know, you go down and you come back up. You go back to your previous trend path. It's not just a cyclical downturn. Part of it is a cyclical downturn. I mean, demand for our products, particularly in the United States, is lower. And there's a cyclical element to that. But part of it is structural. The U.S. has swerved to protectionism. It's harder to do business with the United States. That has destroyed some of the capacity in this country. It's also adding costs. Businesses are looking for new markets. They're reconfiguring their supply chains. That adds costs. So, you know, the fact that this is partly structural and the fact that it's adding costs limits the ability of, or limits the role of monetary policy in boosting demand while keeping inflation low. So, I mean, just to sort of unpack that a little bit more for you. You know, what can monetary policy do? Well, First of all, monetary policy, let me start with what it can't do. I mean, monetary policy can't target specific sectors. It can't target the hard-hit sectors, aluminum, steel, autos. It can't help companies find new markets. It can't help companies reconfigure their supply chains. What it can do is it can try to mitigate the spillovers from the hard-hit sectors to the rest of the economy. And it can try and help the economy adjust to this structural change. But its role is limited because, as I said, this is more than a cyclical downturn. It's a structural change. There are added costs that limits how much we can boost demand and keep inflation well controlled.
Okay, I'm going to go now to Jordan Gowling from Financial Post, please.
Are you signaling that your job is done today? And is it now in the hands of fiscal authorities to help households and businesses further adjust to this, what you call structural transition in the economy? And I know you like to stay in your lane, but is there anything you're looking at in terms of what fiscal policy should deliver next week?
You're right. I do like to stay in my lane, and I will stay in my lane. But let me just get back to the first part. Look, our job is never done. The economy is always evolving. There is a lot of uncertainty out there, and if we needed a reminder over the last weekend, we got one with President Trump's most recent comments. There's a lot of uncertainty about U.S. trade policy. There's still a fair amount of uncertainty about, what is the impact of U.S. tariffs on the Canadian economy? How does this structural change play out? So what all that means is, yes, we've published an outlook today, but there is a wider than usual range of outcomes around that outlook. What we're going to be doing is we're going to be assessing incoming data relative to this outlook that we've published. And look, if the outlook changes, materially, we're prepared to respond. But yes, our message today is that with the cut we made today, and with this, and if things evolve broadly in line with this outlook, we think the monetary policy or the current policy rate is about right to support the economy and maintain low inflation. And with respect to fiscal policy, look, we're all going to see the budget next week. Let's just wait for that. As we always do, we will take on board the new fiscal outlook in our projections. It's going to be less about every specific measures, more about the add up, how it fits together, and what the implications are for both demand and supply in the economy. But let's see the budget first before we get to that.
Greg Quinn from Market News.
Good morning. I wanted to ask about the listing of the Canadian dollar as part of the upside risks to the inflation outlook, and come back again to the idea that in past downturns the Canadian dollar was seen as a shock absorber. It would tumble, help exports, but also change the inflation outlook. I mean, this NPR raises the assumed value of the dollar by a couple cents. I know there's a lot going on on the side of the U.S. dollar, but the questions around the Canada-U.S. exchange rate, are they becoming more permanent in trying to figure out the Canadian dollar's role as a historical shock absorber?
You look like you want to take that question. She wants to talk about the Canadian dollar. Okay, perfect.
Well, I mean, as you well know, Greg, we don't target the Canadian dollar. We put a number in as part of our forecast. I mean, in the type of shock we're dealing with, a trade shock, the Canadian dollar is a key factor. It's a key input to how we think about what's going on in the economy. It's still playing its shock absorber role. I mean, the things that are moving the Canadian dollar are the same things that always do. So there's the price of oil, there's expectations around monetary policy, and then there's just sort of the sentiment around global risk. Some of those correlations have been a bit less tight than they've been historically, but basically the Canadian dollar is behaving the way it usually does in the way it's meant to inside of our monetary policy framework. Not much more to say than that.
Okay, sticking on this side of the room, let's go to John McFarland from Yahoo Finance, please.
John McFarland, Global Finance.
Hi, good morning.
Bonjour.
You've noted that household spending has been resilient so far, even as exports and investment have weakened. But the NPR projects consumption growth to slow quite a bit in the next 2 years. So I want to know how you're thinking about what's going to drive that deceleration and where you get confidence that it's going to fade when it's been holding up.
Well, if it's stronger than we forecast, great, but consumption growth was particularly strong in the second quarter, and we've also seen we also saw a pickup in residential investment. Looking forward, we do expect some ongoing resilience in consumption and housing. We do expect consumption to continue to grow. We expect some modest recovery in housing. And that is an important factor that, I mean, we don't have a lot of growth in the forecast. Growth's modest, particularly in the near term before picking up next year. But the economy, we do have growth, and it's really consumption that the biggest part of GDP that is underpinning that. Growth is very weak in the near term because of exports and investment. You start to see growth pick up next year in 2027 as exports and business investment start to recover. So, I mean, what's underpinning? What's underpinning consumption growth? Well, we've seen some further easing in financial conditions. We've lowered interest rates a further 50 basis points. That will, those factors will provide some support from consumption growth. But there's also some drags on consumption growth. Uncertainty is elevated. Hopefully, things become clearer and that takes down the level of uncertainty facing households and businesses. The other factor is, the unemployment rate at 7.1% is certainly above normal. People, particularly in affected sectors, are feeling uncertainty about their jobs. When you're uncertain about your job, you're much more cautious about your spending. So those are some factors that are likely to weigh on consumption. So we don't think consumption is going to stay as strong as it was in the second quarter. We do think it's going to be resilient. It's going to be a source of growth, but we expect the pace of consumption growth to moderate. The other factor I should have mentioned is population growth is pretty low in the forecast. So if you've got less new consumers in the economy, you're going to get less consumption growth.
Detail to add to all of the points the governor just made. We also saw consumption starting to draw a bit on savings. So that would suggest it's likely to swing too.
Okay, we'll go to Annie Bergeron-Oliver from CTV, please.
Hi, thanks for taking our questions. Given the close trading relationship that we have with the United States, what do you see as the most concerning long-term impact of Trump's trade policies? And also, what is your message to struggling businesses and job seekers about how bleak the economic forecast is?
Well, maybe we'll tag team on this one, but look, I think the reality is open trade with the United States has benefited both our countries for many years now. It allows for a more efficient allocation of production. It allows us to specialize in the production of certain goods, export those, import goods from the United States that they specialized in. We can both benefit from economies of scale. We can benefit from expertise, different resource endowments across the country. Increased trade friction with the United States means all that works less efficiently. And unfortunately, what that means is that unless something else changes, our incomes will be lower than they otherwise would have been. They'll grow, but they'll grow along a low, this was the old path, now there's a new path, which is below the old path. There are things the country can do to try to bend that curve up, but those aren't things monetary policy can do. These are more structural changes. I mean, fundamentally, as a senior deputy governor has hammered many times, we need to get our productivity growth up. And if we can do that as a country, we can bend that curve up. So, I mean, I think what's most concerning is that unless we change some other things, our standard of living as a country, Canadians, is going to be lower than it otherwise would have been.
And in terms of our message about the outlook, I mean, I think if you particularly if you talk to people in the sectors most affected by trade, they don't need us to tell them that things are tough out there. But what we can tell them is we're going to do our job. We're going to support the economy and the transition as much as we can, but we're going to make sure that we don't add an inflation problem to a trade problem.
Okay, let's go to the other side of the room now, and I'll call on Pramit Mukherjee from Reuters, please.
Governor, you have said that if the outlook materially changes, then you will respond. In your view, what is a material change? How will you define this material change?
Well, how about this? I'll tell you when we see one. I think one of the benefits of getting back to an outlook. We still have those scenarios, and they're still useful given the amount of uncertainty there is out there. But one of the advantages of getting back to a base case outlook is we can now assess the incoming data relative to that outlook. And what do I mean by material? It's not a 1 month of data that shows some shift. You need to see some accumulation of evidence that you're coming in, below that forecast or above that forecast enough that it actually changes your outlook of the future. If something comes up a little above, but we think it's just going to come back roughly to the forecast, that's not a material change. But if the outlook really changes, yes, we're certainly prepared to respond. I hope our message is fairly clear today that with this cut and based on this outlook, we think the current policy rate is about right. But we recognize there's a lot of uncertainty out there, and if things, if the outlook changes, yeah, we're prepared to respond.
Okay, Paul Vieira from the Wall Street Journal, please.
Governor, was the intent to signal that policy rate is at the right level because among senior officials there remain concerns about upside risks to inflation as fueled by tariffs and the change in the global economic backdrop?
Well, I think an important element is that above all, our job is to make sure that Canadians have confidence in price stability. Above all, our job is to try to maintain low inflation. As I've outlined, there is a role for monetary policy to play in supporting the economy through this adjustment. But we can't lose sight of our inflation objective. And Canadians have lived through a painful bout of inflation. Cost of living still very much in the minds of most Canadians. It's really important that the Bank of Canada is a source of confidence, is a source of confidence in the value of money.
Okay, let's go to the back of the room now in Canadian Press. I'll call on Justin Escoto, please.
Thanks for taking questions. The NPR mentions the unclear nature of how AI will affect the Canadian economy. Do you think that a further investment in AI could offset the hit from U.S. tariffs? And do you think AI has that potential, or is it too early to tell?
I doubt we said it was unfair in the NPR. It doesn't sound like something we would say, but...
Unclear, sorry.
Oh, unclear. Oh, okay, unclear, sorry. Yes, well, look, AI does have great potential to improve productivity and raise standards of living. Over history, we've seen a series of very important, sometimes called general purpose technologies, computers, the internet, and they have, they've been fundamental in creating new products, changing the way people do business, and those have been instrumental in raising the standard of living of Canadians and, frankly, people around the world. And AI, I think you look at it, it is sort of the next one of these potential general purpose technologies. It has great potential. At the same time, it also has potential to disrupt. In fact, the most recent Nobel Prize in Economics, Peter Hallett and Philippe Aghion, is about just that, the creative destruction, the process of innovation can, even as it's creating new industries and new products, can destroy others. That can put people out of work. So it can be disruptive. So, when we say it's unclear, there are these two elements, and yes, it is unclear, exactly just how transformative AI is, what that balance is between, long-term gain and short-term disruption. These things have played out at very different speeds and different innovations over history. Our sense is this will probably play out faster than previous ones, but we'll see.
Okay, I've got a couple more here in the room before we go to the phone lines. Najoud Al-Malise from Bloomberg, please.
Hi, Governor. Deputy Governor Tony Gravel said that the bank is going to restart purchases of Treasury bills in the fourth quarter to get to the right level of settlement balances. Are your plans, do they remain the same, or are you waiting for more details from the budget?
It is the fourth quarter. I'm going to turn to the Senior Deputy Governor.
I'm going to give you the same update I've given you at the last two press conferences, which is our plan hasn't changed. And if it changes, we would provide advance notice. We would be very transparent and upfront about that. But the plan that Deputy Governor Gravel laid out some months ago remains on track, and we're getting pretty close to the end of normalizing our balance sheet, so everything remains on track.
Okay, and finally here, it's Kevin Carmichael from The Logic, please.
Kevin Carmichael, The Logic.
I have a follow on your remarks about AI, or your answer to the AI question. You'll know as well that general purpose technologies also tend to align with terrible stock market crashes. I'm wondering to what extent you talked about financial stability in this round of deliberations, and just how you assess what you're seeing going on in the U.S. stock markets. Is that a good bubble, as Jeff Bezos says, or is that a bad one, more akin to those terrible stock market crashes that history shows us are all too common in moments like this?
Well, maybe I'll start here and say a couple of things, and Senior Deputy Governor can add. I mean, I think people can have different views on some of these things, but I mean, as you probably saw in the risk section of the Monetary Policy Report, we did highlight one of the downside risks. Yes, equity valuations by many metrics look stretched. The AI boom is in full flight, and there are great expectations for that to pay off. If there were, I'm not saying there will be, but if there were a shift in sentiment about the payoff of that, you could see a sharp revaluation downwards, and against a background of a market that is pretty buoyant, yes, that could have some economic consequences.
I mean, what to add to that, I mean, bubbles are good until they burst, right? So we did have some discussion, directly to your question, Kevin, about the potential for financial stability effects, both, as well as macro effects. When we're deliberating a rate decision, we're pretty focused on macro. In May, if we're still seeing the type of activity and the type of capital flowing into AI when we do our financial stability report, I'm sure we'll deliberate a bit more on that and the potential risks. But for now, we're doing what everybody else is doing, watching it closely and hoping that it doesn't turn into a financial stability risk.
Okay, and I've got two folks now on the line. I'm going to call first on Rob McClister from Mortgage Logic News, please.
Good morning. With respect specifically to housing activity, do your models provide any indication of whether a 25 basis point cut is enough to offset the impact of the trade shock and slowing population growth? Or in other words, is there any meaningful risk that cutting rates today could reinvigorate real estate and cause inflation to remain stickier for longer?
If I understand your question right, Rob, I think we don't specifically model what a rate cut is likely to do directly on housing activity. I mean, we always look at housing activity as part of the overall economy in every rate decision. I mean, I think the difficult thing about the housing market in Canada right now is there's a lot of regional disparity. I mean, if you look at the big urban centers, Vancouver and Toronto, you're seeing pretty soft activity and some steeper declines, but of course those are on much higher price increases. And you still see pretty acute affordability challenges in those markets. If you move into the prairies, you see a bit more momentum. Housing starts are a bit healthier, price declines aren't as big there. And then as you go east, you've got even a more balanced market and even a bit of price uptick in the Atlantic provinces. So it's a really diverse housing market right now. There's some more acute challenges in the Toronto area, in the condo market. So we do see some pickup in housing activity in the forecast. You'll see it's in the NPR we published today, but we'll watch it closely.
And we will take one final question, and that will be from Anna Pereira of the Toronto Star.
Hello, good morning. My question has two parts. So does the Bank of Canada still think that Canada will avoid a recession in 2025? And the second part, I see that you're forecasting some growth in 2026. Where is that growth coming from? Is it from potentially increased government spending or consumer spending or something else?
So with respect to recession, the second quarter was negative. Negative economy contracted 1.6% in the second quarter. Our outlook has growth resuming, but certainly in the second half of this year, we expect that growth to be very modest. Specifically, we are monitoring only half a percentage point of growth, 0.5% in Q3 and 1% in Q4. So certainly, for Q3, it's positive, but it's pretty close to zero. And when you're forecasting a small positive, you can't rule out that there could be a small negative. So yes, we could get two negative quarters. That's not our forecast. We're forecasting modest growth, but we could get a couple of negative quarters. I guess what I would emphasize is, look, whether it's Q3, Q4, small positives, small negatives, they're not going to feel very good. This is pretty modest growth, even in our forecast. And the other thing I would stress, though, is that what we're not forecasting is a sharp downdraft in the Canadian economy with a big rise in the unemployment rate, which is what is typical of recessions. But if you're just looking at sort of the quarterly growth profile, our own forecast is positive but very modest in the near term, and then picking up. So what is supporting growth, and why do we think it will pick up? So consumption and housing actually have been pretty resilient. They were actually quite strong in the second quarter in terms of growth rates. We think consumption growth will moderate for a number of reasons: uncertainty about jobs, lower population growth. But it is being, by lowering interest rates, we are providing a bit more support to consumption and housing. So we expect that they will continue to contribute to growth. Government spending is also contributing to growth in our forecast. That will also help support growth. What's weak in the near term is exports and business investment, and that's why growth is so weak through the second half of this year. Coming into next year, they start to recover, although their path is permanently lower. But they do start to recover, and with that, GDP growth picks up in 2026 and 2027.
And that will conclude today's press conference. So thank you, Governor, Senior Deputy Governor. Thanks all of you for joining us. We'll see you next time. Go Jays.
Go Jays.
Yes, go Jays. Thank you all.
Merci.